Hello guys, welcome to yet another lesson on companies. Today we're going to be looking at the question that followed after question 4.2.1. We're going to be completing the cash flow statement and then we're also going to calculate the ratios. And this is a follow-up lesson, so it's continuing from the last lesson that you have, and some of the figures that you're going to be using are actually from the last video that we did. So please do check out that video if there's anything that you don't understand in this one, so that you can get the full full answer in totality. So without wasting any more time, let us jump straight into it. So in this question, we're obviously dealing with a business called SoFi Limited, and the financial year end is on the 31st of August 2017. And question 4.2.2, we're required to complete a cash flow statement by inserting the details indicated by a question mark. So this, if we go to answer book there, in the answer book, you can see that the figures that are denoted by the question mark, there will be your income tax, your purchase of fixed assets, and then the financing activities as well, and then also the net exchange and cash equivalents. All right, so let us start. So the first thing that we're going to have to look at is obviously we're dealing with income tax, which is the first thing that we're going to try and calculate. So we're trying to calculate how much tax have we paid out this year. So it's not about how much tax has been charged this year, it's about how much tax has been paid for this year. And usually my starting point for me, I usually start with the amount that the opening balance, because if we have an opening balance of the tax that we owe, it means that we first pay that money this year before we can pay any charge for this year. So let's go into the balance sheet. So if you go into the balance sheet, we have an opening balance, which is a debit balance. So if we have a debit balance for tax, it does mean that SARS owes the business, and then SARS would then refund the business that amount of tax. So here we have 2,400. So it means that in the current year, we have received 2,400 from SARS in taxes. So I'll then start my calculation like that. So I'll say 2,400. And then the next thing that I'll go into what is the charge for this year. So the charge for this year is 187,770, and then I'll subtract the whole amount because that's what we charged for the year. So we'll subtract 187,770, and then after that we look at what is the amount that is then owed, or be owed whether by SARS or by the business at the end of the year. So at the end of the year, it shows that SARS income tax is a credit balance. In other words, it's a liability, and the business owes taxes to SARS of 11,800. And if we owe taxes of 11,800 to SARS, that means what it means is that we have not, so we have been charged 187,770. So it means we haven't paid the full amount. So if I subtracted the whole 187,770, it means that I must bring back the amount that is actually not yet paid, which is 11,800. And then in this case, I would then add 11,800, and that will give us 173,570. And also, guys, this is obviously a payment, so this is money that's going out. So if this is money that's going out, it means that we need to put brackets on that money. It's an outflow of cash, it's not an inflow. So we'll put this one in brackets, so it would be 173,570. Cool. And then we move on to the purchase of fixed assets. And then the other one is obviously the sale of fixed assets, so the cash that you receive from buying or from selling your fixed assets. But we'll start with the purchases. So here, when in terms of fixed assets, what we've been given fixed assets at carrying value at the beginning of the year and at the end of the year. And then if you look at and try and find other information that relates to those, we've been given depreciation. And then let's just look at like any stuff that relates to transactions relating to fixed assets during the year. So you can see that fixed assets transactions during the current financial year. So we're told that the old equipment was sold for 324,000. That's an inflow of 324,000 because when you sell equipment, we get money, and in the cash flow statement, we know that our concern is whether there's money involved, and if that money is involved, is it going in or is it going out? In that case, there it says the equipment was sold for cash at the carrying amount of 324,000. So how was that cash involved? We'll see the cash source and inflow. And then they say additional equipment and delivery vehicles were purchased. So here, there's nothing that is actually being said about how much these were acquired for. But I'm just going to show you like a trick that you would use, whether they mention the amount of equipment that was purchased and then not mention the ones that were sold. So the trick is actually quite simple. I just want to go back to one of the questions that we had already answered when we did this paper. It had something like this. So this is a fixed asset note. So the way a fixed asset note is that you know that you have a cost, and then you have minus accumulated depreciation, and then you have a carrying amount. So once you have this carrying amount, what you need to do with this carrying amount in order to get the carrying amount at the end, you take the carrying amount at the beginning of the year, plus additions, minus disposals, and minus depreciation, and then that gives you the carrying amount at the end. So let us write it down in a formula way. I'm just going to go to that page that you are at. So I'm going to write this in sort of like a formula just below here. So what you need to do is so we know that the formula looks like this: CV at beginning of the year. So I'm going to say BOY, and then I'm going to say plus additions. I'm going to call that A, and then I'm going to say, I know that it's minus disposal, so I'm going to say minus D. So that let's just say A minus D, and then also after minus disposals, you also minus depreciation. So for depreciation, I'm just going to say DEPR, and that's just the depreciation. And we know that equals what does it equal? It equals the carrying value at the end. It equals the carrying value at the end. And then in this case, let us just replace these things with numbers and play around with it. So there's some things that we know. For example, we know that the carrying value at the beginning, you can see there 2016, it's 4,975,000. It's 4,975,000. Then we have plus additions, but they just told that additional equipment and vehicles were purchased, so they didn't say how much. So we're going to leave that one as A, and then we're going to go to disposals at carrying value. So disposals at carrying value are given there is 324,000, right? And then you're also told that the depreciation for the current year is 320,000. So you need to also subtract 320,000, and that should be equal to the carrying amount at the end, which is 6,177,000. So that's 6,177,000. And therefore, what you just need to do then would be to say, you would just need to make A the subject of the formula, because you only have one unknown. So we'd say A is equal to 6,177,000, right? And then you'd subtract, because you're taking the 4 million on the other side, so you'd say minus 4,975,000, and then you would take the 324,000 on the other side, and then it becomes positive. So you have 324,000, and then you'd also take depreciation to the other side, which is 320,000, and then it becomes positive 320,000, and that's basically how you calculate your additions. So when you calculate those additions, you will get to, so if you say 6,177,000 minus 975,000 plus 324,000 plus 320,000, you will get 1,846,000. So let's just put the calculation here. It might be difficult to, maybe there's just not enough space. Right, let's try. Yeah, so that is the calculation right there. So that's the calculation right there, and then the answer would then be, the answer at the end would then be 1,846,000. So obviously, in this case as well, this is an outflow because if you're buying additional fixed assets, you're spending money. So if you're spending money, then it becomes an outflow. If they said on credit, then we wouldn't really have it here, but they did say that they were purchased, and we will assume in this case that they were actually purchased for cash, because we're dealing with the cash flow statement. Otherwise, if they didn't say, if they actually said credit, then we would not put it in because we're interested in cash. And then the other part of the cash flow statement is obviously, because this question mark right here we have to solve. So these would be the proceeds. These are the proceeds from sale of fixed assets. And you know that fixed assets are sold at carrying value for 324,000. So there's no need to calculate there because you already know. And also this one, we're receiving money, so it will not be in brackets because that is money coming in. And then moving on to financing activities. So we already have a change in non-current liabilities. So if we have a change in non-current liabilities, we know that the other things that are left would include proceeds from sale of shares, and then we'd also have a repurchase of shares, and that is exactly what we have. So we're going to start there. We're going to say proceeds from sale of shares. We do know that 150,000 shares were sold for R630, and we've also calculated that in the previous question. So you might want to go and watch the other video. So was sold for 630, and that would then give us an amount of 945,000. Then we know that the thing that will follow is the repurchase of shares. And let's just go back to the information maybe so that I can refresh. But if you think about this is the information that we have here. So, you know, authorized share capital, 1.2 million shares, and then we told that 900,000 shares were issued at the beginning of the year, which is 1 September 2016. And then it says here the company issued 150,000 ordinary shares at R630 per share. We've already calculated that to be 945,000 of receipts. And then we also told here that 70,000 ordinary shares were repurchased from shareholders, and then a check of 437,500 was issued for these shares. So in this case, we're not really concerned about whether we sold them at a profit or a loss. We're just concerned about how much was paid for these shares. And in this case, 437,500 was used to pay for these shares. And so that would be an outflow. So we'd have an outflow of 437,500. It will be an outflow because we're paying that money over to shareholders. Cool. And then just looking at the last part, then we were dealing with the cash and cash equivalents. So when it comes to cash and cash equivalents, we're going to start, let's start by, before we go into the net change, I would advise that you start with the opening and the closing balance, because those are the ones that will assist you in calculating the net change. So what you need to do then would be to go to your balance sheet and look at your cash and cash equivalents. So at the beginning of the year, we had cash and cash equivalents in the balance sheet of 2,500, but also had a bank overdraft of 65,100. And then in that case, our cash and cash equivalents at the beginning of the year would have been, I'll just put the calculation right here so I can make sure that you guys are able to see it. So obviously there was 2,500 that the business had, but it also had a negative balance in the bank statement. So there is a negative balance, which is the bank overdraft of 65,100, and that would give you cash and cash equivalents of at the beginning of the year of 62. Because it's negative, 62,600 of cash and cash equivalents. And then at the end of the year, how much cash and cash equivalents we have. So we have no bank overdraft at the end of the year, and we have 23,400. So we go and take and put this 23,400. It's a positive balance. 23,400. And then to calculate the net change. So the net change is basically from the position that we were at when the year began and the position that we're at now, how much has been added or subtracted in our bank, in our cash and cash equivalents. Sorry. So we had negative cash and cash equivalents of 62,600 when the year began, and we were ending the year with 23,400. So it means that we have added more money to our bank account. Firstly, we added the 62,600 to wipe out all that negative balance, and then on top of that, we added 23,400, and therefore, in order to calculate the net change in cash and cash equivalents, would be to basically add the 23,400 to the 62,600, and the net change in cash and cash equivalents would then be 86,000. And in order to check that you're correct, you would have to say the net change in cash and cash equivalents, and then you subtract the opening balance. It should give you the 23,400 again. So that's how you would know that you have calculated your net change in cash and cash equivalents correctly. So that's it for the cash flow statement. And then we move on and answer other questions. So the other question, calculate operating profit on sales ratio. So in order to calculate operating profit on sales ratio, we just need to know what is what's the profit that we have. So sorry, I didn't say so it says calculate the operating profit on sales. So let's go and see what our operating profit is. So operating profit is 697,000. And our sales is 8,652,000. So to answer this, we would simply just take 697,000 divide by 8,652,000, and then we'd multiply the whole thing by 100, and then we would get an answer of 8.1%. Then the following one, calculate the debt to equity ratio. So in this case, we have to find what is our, so debt to equity ratio is non-current liabilities to shareholders' equity. So if we go to liabilities, so we have current liabilities here, and where our non-current liabilities. So so yes, so now you can see here that our non-current liability is the loan from Dolphin Bank for 985,000. So we have 985,000, and on the flip side of that, we need to calculate then how much is shareholders' equity. So shareholders' equity. So we have ordinary share capital, but we don't have retained income. But luckily, we answered a question in the previous question where we were basically completing the note for retained income, and we knew that we had 5292 and 250,000 as our shareholders' equity. So we add the share capital, and then we'd also add the retained income amount. So we'd say we'd say 5292,000, and then we'd add 250,000, and then say 985,000 is when we add all of that, we get 542,000, and then we divide both sides by 5,542,000, and then we end up with 0.2 is to 1. Cool. And that's basically what the debt to equity ratio is. 0.2 is to 1. And moving on to the next question, they say calculate the dividends per share of a shareholder who owned the same number of shares for the entire financial period. All right. So there's a few things we know. So we were told, for example, if we look at this, there's an interim dividend of 12 cents, and there's a final dividend, which you said it was 168,000 because it was the amount that was still yet to be paid by the end of the year. So in this case, what we need to do is to say we're going to take shareholders dividends amount. So we're going to say 168,000. Then we're going to say divide by the number of shares that have been issued. So it says here for someone that has owned the same number of shares for the whole year, so they didn't sell their shares. But what happens is that, so if I'm a shareholder in a company and I own all the 100 shares, so let's say the company has has 95 shares in issue, and I own all those shares. So when the business pays a dividend of 10,000, that 10,000, all of it comes to me because I own all the shares. But if the business issues shares, let's say they issue 5 more shares, and then the shares that are in issue are now 100. Now it means that I no longer own 100% of the company, but instead I own 95% of the company. So when a dividend of 10,000 is being paid again, it means that I'm going to get 9,500, and then the other person is going to get the 500. So in this case as well, we need to make sure that we're not only looking at the number of shares at the end, but we look at the entire shares that were issued. We will not include the ones that are not issued because this person owned the same number of shares for the whole year because they didn't sell. So in that case, you'd have to divide by 900. So the way obviously shares that were issued at the beginning of the year was 900,000. So you'd say 900,000. Then you'd add 150,000 shares that then got issued. To make it simple, you can just save yourself a lot of trouble instead of adding that amount and putting solid brackets, and just divide by 1,050,000, 1,050,000. Then you multiply that by 100. Um, and then on top of that, you would have to add the interim dividend, because that shareholder got the final dividend, but on top of the final dividend, he also got the interim dividend, which was at 12 cents per share. That would then give us 28 cents or 0.2. So it would be 28 cents per share for these dividends. And let me just check if there's any more questions. There's no more questions. So you can see there how I worked that out. You just took the final dividend, it was paid so many shareholders, and then we multiply that by 100, and then add the interim dividend, which was 12 cents per share, and then we get 28, and then we get 28 cents per share. Thank you guys for tuning in, and tune in the next lesson. Cheers.